So the big question is this: how do investors like us who trade options and manage our own money generate income regardless of where the stock market goes, and do it all in a way that lets us make time for the people and things we love, and yet still build wealth and remain profitable? That's the question, and this podcast will give you the answer. I'm your host, Kirk Duplessis, and you're listening to The Daily Call from Option Alpha. Hey everyone, this is Kirk here again at OptionAlpha.com. Welcome back to The Daily Call. Today we are going to be talking about quadruple witching, what it is, and should you pay attention to it. So quadruple witching, which is honestly the craziest term that options traders could have come up with, but I guess it makes sense for what it basically means. And that is, it refers to the third Friday of every March, June, September, and December, basically the ends of quarters every year. And so on these days, what ends up happening is you get 4 different styles of contracts that basically expire on the same Friday. That's why they call it the quadruple witching. And more oftenly, they refer to it as quadruple witching hour, which is the last hour of these trading days, 3 to 4 Eastern Standard Time, that generally sees that increase in volatility. But on these 4 days during the year, these 4 end of the quarter expiration days, you get market index futures, market index options, stock options, and stock futures that all expire on the same day. So this naturally creates increased volatility in the markets, naturally creates increased volume. In some cases, I've seen research where they say the volume increase is in some cases 50% higher than the general days on average. And so what happens is that we get to the end of these quarters and all of these different products are expiring at the same time. So institutions and regular traders have to make decisions. And that's why it becomes such a volatile time period, especially towards the end of the day, this quadruple witching hour, because people have to make decisions. Do we keep these hedges on? Do we, speculate on new products? Do we roll contracts? Do we close out of contracts? How aggressively do we do this? But it's all going to happen before the end of the day. So that's why we see this increased volatility and this increased volume in the market. Now, that's basically what it is. The question I always ask is, should we care? I think we should at least know that it's coming, at least be present and have the awareness to know that quadruple witching is happening, because we might see more volatility in our options positions. We might see more volatility in the underlying market. And that doesn't necessarily mean anything. Like volume and volatility just mean that there's more gyrations. It may or may not distinguish a big trend. There's no discernible research that has been out there that we've found that says that quadruple witching always is an up day or always is a down day or always means the turn of a trend. If we're going up, now we're going to go down, or if we're going down, now we're going to go up. None of that stuff actually happens. There's no discernible research that says it leads to one thing or another. So all we can then determine is that there's just a lot more fluctuation in the market and a lot more volume. And so if I'm trading options around this day, I know that it happens, I know that it's coming, and I just know to be aware that there's going to be some more gyrations in my positions. And if you know that that happens, you should be okay. It doesn't dramatically change in any way, shape, or form how we trade options, how we think about strategies, how we execute new positions. In most cases, we've actually seen a lot of profit taking on those days. So when we get into quadruple witching, we'll start again putting on a lot of our contingent closing orders into the market so that if there are gyrations that end up, going past one of our profit taking points, we take profits while there's profits to be taken, right? So I would say use the increased volume and the increased liquidity to your advantage to take advantageous and opportunistic profits when they present themselves. So hopefully this helps out. Hopefully it was a pretty simple explanation. It's not really much else besides what we described here, so don't read too much into it. It's something you should be aware of. It's something that obviously causes a lot of volatility and volume in the market, but it doesn't dramatically change the outcome and it doesn't dramatically shift how we should be trading or how we should be using option strategies. As always, hopefully you guys enjoy this. Until next time, happy trading. Thanks for joining us on The Daily Call. Be sure to subscribe right now for more daily options trading ideas, strategies, and tactics to help you learn how to place smarter, more profitable trades. And if you like what we're doing, don't forget to give us a rating and a review so we can continue to bring you the best daily content possible. We'll see you again tomorrow, right here on The Daily Call from OptionAlpha.com.